When I first started investing, I thought I was doing everything right. I'd watch a few videos, read a few headlines, buy a few stocks everyone was hyping up and talking about, and then panic and sell when they dropped. One week I felt like Warren Buffett and Charlie Munger. The next, I was wondering if I should have just left my money in a savings account so I wouldn't keep losing it. If you've ever felt that way, excited, overwhelmed, or maybe a little lost, this video is for you. Because after years of wins, mistakes, and lessons, I've realized there are 10 things I wish I knew when I first started investing in stocks. And today, I'm going to walk you through each one so you can skip the trial and error, avoid the stress, and actually start building wealth the right way. Welcome to Seven Hills Equities, where we make investing make sense. If you like practical, no-hype investing lessons that actually help you grow your money, consider subscribing. Now let's get into it, because these 10 lessons completely change the way I invest. Lesson 1. Know your why. When I started, I thought investing was all about finding the next hot stock, but the truth is, if you don't know why you're investing, you're already off track. Your why determines everything else: your timeline, your risk level, your strategy. Are you investing for retirement in 30 years, or trying to save for a house in 5? Those are two completely different games. When I finally sat down and got clear about my time horizon, I stopped panicking during dips. Because when your goal is long-term, short-term volatility doesn't feel like chaos anymore. It just feels like part of the process. Lesson 2. Emergency fund. This is one I learned the hard way. Early on, I put every spare dollar into stocks because I wanted to make my money work for me as much as I could. Then my car broke down. Guess what I had to do? Sell stocks, right when the market was down. Having an emergency fund, 3 to 6 months of expenses, isn't just a safety net, it's what gives you the freedom to be a calm investor. When life happens, and it always does, you'll be thankful you don't have to touch your investments. It's not exciting advice, but it's what separates investors from gamblers. Lesson 3. Diversity. I once put almost everything I had into one company because I believed in it. I read every article, every forecast, and then earnings came out, and the stock dropped 40% overnight. That was the day I learned what diversification really means. It's not about owning different stocks. It's about spreading risk smartly, across sectors and ideally through simple index funds. Diversification is the seatbelt of investing. It doesn't make you faster, but it keeps you safe when things crash. If I had just held a basic S&P 500 index fund back then, I would have been way ahead of where I ended up. Lesson 4. Fees. Here's something no one told me early on. Even a small fee can drain thousands of dollars from your returns over time. A 1% management fee might not sound like much, but over decades, that could mean retiring with tens of thousands less. These days, I avoid high-fee mutual funds and prefer low-cost ETFs or index funds. When you're starting out, focus on what you can control: your costs, your savings rate, and your discipline. Those matter far more than guessing which stock will beat the market next quarter. Lesson 5. Dollar cost averaging. Here's a simple truth. No one, not even professionals, can perfectly time the market. So instead of trying to buy at the bottom or sell at the top, just invest a little bit consistently. That's called dollar cost averaging, and it's powerful. When prices are high, your money buys fewer shares. When prices are low, you buy more. Over time, it smooths out the volatility and builds wealth automatically. When I started doing this, setting up automatic contributions every month, it took all the stress out of investing. You stop thinking like a trader and start thinking like an owner. Quick pause. If this video has helped so far, hit that like button. It tells YouTube this kind of content actually helps people learn investing. Lesson 6. Tax-advantaged accounts. This one confused me at first. IRAs, 401ks, Roths, it all sounded like alphabet soup. But once I learned how these accounts work, it completely changed my returns. Tax-advantaged accounts aren't just nice to have. They're like adding turbochargers to your portfolio. If you have access to a 401k, especially with an employer match, start there. That's free money. If not, open a Roth IRA and let those gains grow tax-free for decades. Compounding is powerful, but tax-free compounding, that's life-changing. Lesson 7. Have a plan. I used to buy based on excitement. Now, I invest based on a plan. The plan doesn't have to be complicated, it just has to be written down. For example, 70% stocks, 30% bonds, rebalance once a year. That's it. Having a clear plan keeps you calm when the market goes crazy. Most people lose money, not because they pick the wrong stocks, but because they abandon their plan when emotions take over. Your plan is your anchor. Write it, trust it, and follow it. Lesson 8. Time in the market. You've probably heard that phrase, but let me explain it in real terms. If you missed just the 10 best days in the stock market over the last 20 years, your total returns would have been cut in half. Half, just from missing 10 random days. That's why I stay invested through the noise. Markets rise and fall, but long term, they've always trended upward. When you zoom out, those scary dips look like tiny speed bumps on a long upward road. The goal isn't to be perfect, it's to stay in the game long enough to let compounding work for you. Lesson 9. Risk tolerance. I used to say I could handle big swings, until I watched my portfolio drop 25% in a month. Turns out, it's easy to sound brave when stocks are going up. Knowing your real risk tolerance means understanding how much volatility you can stomach without losing sleep. It's okay to be conservative if it helps you stay consistent. Investing should challenge you, not scare you. The best portfolio isn't the one that looks smartest on paper. It's the one you can actually hold through bad times. Lesson 10. Filter noise, keep learning. When I started, I was glued to the news. Every headline, every tweet, every expert prediction. It made me anxious and reactive. Now I follow a handful of trusted voices and ignore the rest. The less noise you let in, the better your decisions become. Also, keep a simple, investing journal. Write down why you bought something, what you expect, and what would make you sell. 6 months later, look back and see what actually happened. You'll learn more from that than any book or video. Over time, you'll start noticing your own patterns, what works, what doesn't, and how you think under pressure. That's how real investors are built. Let's recap. Know why you're investing. Have an emergency fund. Diversify. Watch your fees. Invest consistently. Use tax shelters. Follow your plan. Stay invested. Match your risk to your temperament, and filter out the noise. Simple ideas but powerful when you actually live by them. And here's the truth that ties all 10 together. Behavior beats strategy. You can build the smartest portfolio in the world, but if you can't control your emotions, it won't matter. If this helped you, hit like. It tells YouTube that real grounded investing advice deserves to be seen. And subscribe to 7 Hills Equities for more videos like this, where we make investing simple, practical, and stress-free. Drop a comment and tell me, which of these 10 lessons do you wish you learned earlier? I read every comment, and your stories might even inspire a future video. Thanks for watching. Start small, stay consistent, and I'll see you in the next one.